Hello, my name is Robert Tuttle. I'm an energy reporter based in Calgary, Alberta, today I'll be speaking with Lars Glemser, VP and CFO of Vermilion Energy, and Rodney Gray, CFO of Baytex Energy. So I'm going to let both of you describe your company, but let me just start by saying that today Brent oil is near $80 a barrel, and you think back just over a year ago, the world looked like oil was negative, and it seemed as though the world energy demand had maybe peaked and was perhaps not going to reach what it did at pre-pandemic levels. And yet here we are today, high oil prices. We have extremely high gas prices in Europe and Asia, and filling stations in the UK that are running dry due to a shortage of truck drivers. But so in this situation, we seem to be in an energy crunch. So I'd like to just start by asking, I'll start with you, Lars. I mean, your company is very global. How are you navigating this situation currently? Just tell me a little bit about your company and how you're navigating the current situation.
Great, thanks, Robert, and thank you to Bloomberg for hosting us today. And you put it well, Robert, what a difference a year makes. Certainly a lot different backdrop than it was in 2020. And I think from Vermilion's perspective, we've been around 27 years, and for 24 of those 27 years, we've had an international presence within our portfolio. So we do like to think that we take a bit of that longer term view on the business to navigate some of the peaks and valleys that are inevitable in our industry. And we think that is one of the attributes that we offer to investors is we are geographically and commodity diversified, which I think provides a lot of risk reducing attributes, whether you're on the debt or the equity side of the investment. To put that into perspective, you look at European gas pricing right now, stripped for 2022 is in excess of $20 an MMBTU in Canadian dollar terms. So we think that is one of the attributes that we bring to the table. I think in terms of how we're navigating the current environment, we've had a strong focus on generating free cash flow for the last number of years. Previously, it was all going to fund the dividend in terms of a equity-friendly return to capital policy. I think with some hindsight, we let our simple payout ratio get a little bit too high in terms of to that 40 to 50% range. And the other sort of observation was in 2020, our debt levels were too high, and it made for an uncomfortable year. So we have been very focused over the last 18 months on debt reduction. To put that into perspective, we are looking to generate in excess of $400 million of free cash flow here in 2021. From an equity standpoint, that's about $250 a share. However, here in the short term, that is all going towards debt reduction. We exited 2020 at 4 times debt to cash flow. We're now forecasting to exit 2021 2 times or less debt to cash flow. And then we think that there's line of sight to achieving our longer term target of 1.5 times or less at some point in 2022. So, I think here in the short term, we'll have a continued focus on debt reduction. As we look at 2022 and start to plan that year, we will have a lot larger focus on return to capital and a potential return to paying a dividend. We've been quite vocal with our investors, debt and equity side. We do want to return to a dividend paying model or return to capital strategy. What 2021 has done is accelerate those type of discussions. So I'll leave it there, Robert.
Thank you very much. Rob, tell us a little bit about your company and how you guys are navigating the current environment.
Sure. Thanks, Robert. And thanks for having me join you and Lars today. Appreciate the opportunity to share some perspectives on Baytex and the industry. By way of background, Baytex is a North American energy company that's operated for over 25 years, very similar to Vermilion. We do have our production that's basically just in North America. So we produce about 80,000 barrels a day. 60% of that would come from our Canadian operations, which is located in the provinces of Alberta and Saskatchewan. And 40% would come from our production that's located in the Eagle Ford position in South Texas. We do trade on the Toronto Stock Exchange with a market cap of about 1.8 billion, an enterprise value that's closer to 3.4 billion. Obviously, those numbers are pretty dynamic as of late, but they are moving around. And we do have two public debt deals outstanding right now, one that matures in 2024 and a second that matures in 2027. So maybe more specifically to recent events and how we're managing the business, we originally set our plans for 2021 based on a $40 to $45 WTI price environment. Our plan had us investing $250 to $275 million and generating approximately $150 million of free cash flow. Since then, we've seen a significant improvement in commodity prices. And with the increased prices, we did a couple things that were unique at the time and were announced with our first quarter results. So one, we announced a 5-year plan that outlined our priorities and demonstrated our free cash flow generating capability of our assets. And two, we revised our capital spending plans modestly higher for 21, increasing by a little over 10% to approximately 300 million at the current midpoint of guidance. And this really sets us up for the planned period. But also now we're forecasting to generate over $350 million of free cash flow. So when we look at our planned priorities, disciplined capital allocation, maximizing free cash flow, improving our leverage ratios, and enhancing shareholder returns. So very similar to what Lars has laid out for Vermilion. We've laid out what we think is a very disciplined 5-year plan that sees our production remaining stable in the 80 to 85,000 barrel a day range, investing less than 70% of our funds flow with annual capital spending of about $400 million. And with that, we see ourselves generating over $1 billion in cumulative free cash flow through 2025 out of US $55 WTI price environment. This grows to over $2 billion at 65. And obviously with prices today, that's significantly higher. So with that free cash flow comes several options, as you'd suggest. First of all, I'd say our number one priority is to further strengthen our balance sheet, which is where all of our free cash flow in 2021 is being directed. We're targeting a net debt to EBITDA ratio that's around 1.5 times in a $55 environment. And so for us, that means debt of, call it $1 billion to $1.2 billion. And at current prices, we'd expect to hit that $1.2 billion level, probably by the first half of 2022 now. As we hit our debt targets, I think we'll be in a much stronger position to consider enhanced shareholder returns, and that could come in the form of share buybacks, dividends, or organic growth opportunities. At our current valuation today, we'd probably be leaning towards more to share buybacks, but we'll see where we get as we approach our debt targets. The other update that's new and exciting for us, Baytex, is our emerging Clearwater play in the Peace River region, an area where we've amassed 80 sections of land in partnership with the Peavine Métis settlement. We've drilled 5 wells on the lands to date, and our production's gone from 0 to just over 2,300 barrels a day. This is an asset that we think has among the strongest economics in the industry today, and most importantly, at current pricing, can actually grow within its own cash flow. So to put this into perspective, at $60 WTI, we see IRRs of over 300% and payouts of under half, payouts in less than half a year. At current pricing, these wells pay out in 2 to 3 months, so they're exceptionally profitable. So this is an asset that fits very well within our business model, and we believe it enhances the overall plan that we've got and put forward. So we haven't built this into our 5-year plan, so we feel as we continue to delineate our lands, this will only strengthen our overall business. So as you can probably tell, I'm pretty excited about where we're at today, and I could talk for a while, but maybe I'll stop there for now.
Thank you very much. I mean, one common theme you sort of both talk about is being disciplined, returning, paying down debt, returning capital, returning cash to shareholders. And yet, we're looking at, a real crunch in energy. We have these extremely high prices. So your companies aren't terribly different from a lot of other companies that are trying to be very disciplined. But when do you see, this real high prices reaching such a level that you are going to reinvest it in drilling more and capital and capital budgets. Let's start with you, Lars. Well, how about you guys? I mean, you guys are in Europe, so you've got a real exposure to the gas prices there.
Yeah, no, good question. And, similar to Rod at Baytex, we started 2021 with a $300 million capital budget, and we were quite transparent that we were not spending to our sustaining level of CapEx. So we were letting production decline. Our sustaining CapEx is probably more in the $375 million range. What we'll start to do here for 2022 is get more line of sight around what we're going to do operationally. So, for example, we are likely to drill 2 wells in Australia in 2022. That'll add about $50 million to that sustaining CapEx number. So we are getting more comfortable with a little bit more investment into the asset base. At the same time, though, we're targeting about 84,000 barrels a day of production here in 2021. That low to mid 80 number is a production number that we'll be targeting for 2022 as well. So that won't be changing. We'll have about 50% investment into our international business, 50% into North America. And, I think what we are really hearing from the capital markets is in the near term here, the industry needs to repair its reputation from a profitability perspective. And as a result, growth is not only going to not be rewarded, but it may be punished as well. And my view is that over the next couple of years, there will be certain companies that potentially earn the right to grow in terms of showing investors that there is profitability within the industry and within certain companies. And I think that is where our focus is going to be as well in terms of spend to sustain current production levels, and then look at what the appropriate uses of free cash flow beyond that. And, I'd say one of the items that we are open to is M&A as well, in terms of where does that compete with potentially returning capital. So that'd be the Vermilion view here in the medium term.
Yeah, thank you. Rod, you said you did boost your capital budget a little bit earlier in the year. I think, what is your outlook? I mean, what's going to motivate you guys to really ramp up drilling and production?
I think Lars touched on it. I think in general, you're going to see continued capital discipline in the industry. Message has been pretty clear from investors: maintain capital discipline, drive free cash flow, and look to provide returns to shareholders. I think over time, this should improve investor sentiment for our industry, which is positive for everyone. But I also think it's going to be, it could vary slightly company by company. For Baytex specifically, we're laser focused on maintaining capital discipline and striving to maximize our free cash flow. But having said that, I just talked about the emerging play located in the Peavine-Métis settlement that's not included in our 5-year plan, but in current prices can grow within its own cash flow and has the potential to generate significant upside for our business. So you could see a modest increase to our capital, but we're talking very little there in terms of overall impact to the capital program.
Well, thank you. Lars, you spoke a little bit about the mergers and acquisitions. We've seen so much activity, especially here in Canada recently. We had the Inter-Pipeline deal on the midstream side, but we've also seen some upstream players as well doing deals. Where do you guys, do you see opportunities for acquisitions or anything on that scale, Lars?
Yeah, no, and I did reference that, and I think if you look through the history of Vermilion, we've been a good acquirers of assets. I think the best acquisitions we've made have been where we have an operational presence already. For us, that's a pretty broad landscape in terms of Australia, Europe, and North America. We will continue to evaluate opportunities. I think first and foremost, our preference is to do M&A in Europe. We think that we truly bring a competitive advantage to Europe, less competition as well, which benefits the buyer opposed to the seller. The issue with Europe is there's a little bit less deal liquidity, so we do have to be patient from that perspective. Now, you referenced some of the bigger deals that have occurred here in North America, whether it's Canada, US, upstream, midstream. I'd say we're less interested in that merger of equal type acquisition activity. We're more interested in creating more scale where we already have an operational presence, and looking at synergies just in terms of what we can bring versus the previous operator. And hopefully we have some time to touch on it, but those synergies would include on the ESG side as well, which we think is important. So we'll continue to evaluate. And if we can make an acquisition deleveraging as well and accelerate the debt reduction targets as well, we'd look to be opportunistic there.
Thank you. How about you, Rod? What do you say?
Similar to Lars at Vermilion, I think we're always looking for assets in and around our operating areas. So if there's tuck-in acquisitions that we're able to look at, we're always evaluating those. I think we're very focused on making sure the asset quality is there, though. So how do the assets actually compete against our current portfolio? We'd characterize our current core assets as having 10 years worth of development inventory on each of those assets. And so when we look at M&A opportunities, we've got to make sure that they're actually accretive to the existing portfolio. Otherwise, you're delaying them for several years and the actual profitability just isn't there. So we're very focused on asset quality, given that we've got a set plan here and looking to make sure it's accretive, but always looking for opportunities more in and around our areas. And Lars touched on it as well. I'd say we have a bit of a different lens to some of the M&A opportunities out there. And that lens is really the ESG lens, and see how it's going to impact our overall operations go forward, whether it be GHG emission intensity or water usage, or just in terms of where the operations are located. So maybe I'll leave it there.
Thank you. Just real quick, you both sort of, Lars, I mean, maybe I can touch a little more on that ESG theme. I mean, where do you, what is your outlook on that? Do you think that the industry can sort of overcome this, the image it has these days of among a lot of investors being shunned because of that? How do you guys approach that?
Yeah, so both Rod and I have touched on the importance of ESG in terms of capital allocation decisions. And, similar to, we take a lot of pride in putting out production and capital guidance, meeting it, as well as our debt reduction targets. No different on the ESG side of it. So we've got a commitment to 2050 net zero. I think more importantly, we have shorter term commitments in terms of GHG reductions around scope 1 by 2025. We want to reduce by 15 to 20% from 2019 levels. And that is now a target that we have out there, and we are openly talking about it. I think it's interesting in terms of, again, both Rod and I touched around skepticism within the industry from a profitability perspective. There's also that ESG skepticism of the industry. And I'm fairly, positive, I guess, over the longer term that I think capital will start to recognize that there are responsible producers of energy, and we're going to be doing the right thing from a E perspective in terms of the ESG theme. And then I think, what capital market providers need to do is make sure that we are also delivering on the social aspect of ESG, making energy affordable to consumers as well over the longer term. And I think there will be a recognition that these traditional energy producers like Vermilion and Baytex, they deserve investment to make sure that we deliver on all three components of the ESG discussion. So that's where Vermilion is at.
Thank you. Rod, I mean, any more perspective you can put on that?
I think Lars touched on it. I'd say overall, we've probably done, as an industry, we've done a poor job of demonstrating a lot of the good things that we've done in terms of regulations that we operate within and changes that we've made to our overall operations. But at Baytex specifically, I think we've been reporting on these initiatives for well over a decade, but we've definitely seen them change over the last years. Almost exponentially. And there's all these different reporting frameworks and things and gathering the information. And I think the industry itself is almost in a stage where they're gathering a whole bunch of information. We're trying to standardize some of that information and reporting. And then eventually, I think you'll probably see some external attestation of that information. And I think that'll go a long ways to improving the overall a reputation and probably differentiating companies quite significantly in this area, because there's certain companies that are taking it very seriously and embedding it within their culture, and we would consider ourselves one of those. But then there's also different geological or geographic areas of operations that would have very different social programs and or overall governance that we think will matter down the road. So we're paying attention to this, and we've set some significant goals and targets for that.